in the last couple of days.
Okay, with that, let's parse the global environment a little more because it's an extremely important week with the FOMC meeting, November 1st and 2nd. We will be able to react only on November 3rd morning. Mark Matthew of Bank Julius Baer and Company joins us. Good morning, Mark. Thank you very much indeed for joining us. The market seems to be priced to perfection, expecting that the FOMC statement will indicate a step down to 50 basis. You think the market is in a fine spot, or is it being a bit too confident?
Oh, that's a good question. I mean, we have gone up 13%,
yes.
What was it? 12% from where we were in the middle of October. So clearly there's anticipation that the light's at the end of the tunnel. I think it's right. I think it's right to say that because the forward-looking inflation indicators are telling us that. The most important is property in the United States. Price of goods isn't the issue anymore. It's the price of services, particularly property. And the listing platforms for apartment rentals are showing quite a large leg down in the asking prices of rents in the month of October. So I think that the data will continue to show us that inflation peaked some time ago and is coming off. And if you look at the so-called Anglo-Saxon central banks, that's what the Europeans like to call them, the Bank of England, the Federal Reserve, the Bank of Canada, the Reserve Bank of Australia, Reserve Bank of New Zealand, they tend to act loosely in a group historically. And at the beginning of this month, we had the Reserve Bank of Australia sound a note of caution. They hiked by 50. The market was looking for 75. Last week, Bank of Canada was supposed to hike by 50. They did 25, also sounded a note of caution. And so I think that we can tell the wind is shifting to a more accommodative policy globally. And I think that'll include the Federal Reserve.
Hi, Mark. Morning. Mark, but what would be termed as this dovish or slowdown? Because 75 basis points we're going to get, in November. Do you think that if they could indicate that maybe we don't get 75 in December as well, what are you factoring in? And then we come to an end, and then we see a bit of a U-turn in 2023? Is that what you're factoring in?
Yes, I think, Nigel, that would be a perfectly logical assumption. The market will not be shocked if we get 75% in the November meeting, but it is looking for some discussion about deceleration in the rate trajectory. And it's doing that because three important Fed officials have sounded caution.
Yes.
They are the chairwoman, Lael Brainerd, the San Francisco president, Mary Daly, and the Chicago Fed president, Charles Evans, who, by the way, all three are Democrats, I might add, but that's beside the point. The thing is that I think they will want to have that discussion, and that should appear somehow in the notes or the statement. And the market will interpret that as 50 basis points or even possibly less in December, and the dot plot being revised down because we're also going to get the dot plot in December. And that, I think, will be enough to take us into a year-end rally.
Mm-hmm. Right, Mark, I take your point about, there being some light at the end of the tunnel, but for us, we have to be doubly sure that that light is not that of an oncoming train. And that perhaps could be that of China. I'm looking at the Chinese economic data that is weaker than what the street was anticipating. And now the thesis is that so long as China remains weak, and the world is looking at emerging markets, India will remain to be a beneficiary, notwithstanding the valuations. Do you think there is merit to that? And how do you view the allocation vis-a-vis valuation for both India as well as China?
I 100% subscribe to that view, that what's happening in China is a tremendous blessing in disguise for India and for many other countries. Where I am here in Singapore, absolutely that's the case, in Southeast Asia. But India is a much larger market than these small Southeast Asian markets, and so it's the one that people will naturally look to first when they try to find alternatives from China, because China has been the story that's really kept all the other emerging markets off the radar screen of global fund managers for the last decade. So China is very cheap, there's no doubt about that, but I think it's also cheap for a reason, and India is expensive, and it's expensive for a reason. And just like you wouldn't have wanted to sell tech stocks 10 years ago because they looked expensive at the time. I wouldn't want to sell India today because it is higher than its peers.
Okay. Well, just a final question, Mark. What do you, I mean, it's a very near-term trader question, but I still want to ask you, do you think the market will pause and wait for the FOMC statement before it takes the plunge of going ahead and buying more?
Oh, I can't answer that. I'm sorry, lad. Total coin toss. I don't know, but look at the way the market reacted to Apple. So it's still got, you know, if you can show it good stories, it will certainly reward those good stories.
Okay. All right, we leave it at that, Mark, and we will touch base with you when the FOMC statement is out. Thank you very much indeed for joining us and giving us, parsing the global environment for us. Just a word, you know, Nigel, you were pointing out that we underperformed. If the tailwind is so much in favor of developed markets, I think the FOMC positive statement could also mean that we will